Hello, chart watchers, and welcome to this Wednesday, October 17th, Market Watchers Live Show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Take a look at what's going on in the market so far today. The Dow Jones Industrial Average was down a couple hundred points earlier, but is now rebounded, currently down just 58 points. The S&P 500 also rebounding off intraday lows, currently down 2 points. The NASDAQ down 17 after rebounding off of its lows, while the Russell 2000 continues to underperform so far today. It is down close to 1%, down 14 points currently. 10-year Treasury yield flat today at 3.16%, digesting some housing data. We'll talk about that in a bit. Volatility index, after hitting that 29 high last week, continues to soften, and we are back down under 18. We'll take a look at the VIX later. Financials under pressure recently. As you can see, the breakdown below that 2750 area. But the last couple days, we've rebounded, and currently financials leading the action to the upside. Among the financial industry groups that are performing well today, we've got life insurance bouncing back, trying to move up to about a 4-day high. Banks also, after moving below a key area around that 450 level, have rebounded back above that. Banks having a nice day. On the flip side, though, we have energy, which just literally a week, maybe 6 trading days ago, trying to make a breakout above that key resistance at 77.78. You can see that failure, that intraday failure, came back down. We have gone down since, and now we're back down challenging support around the 72 level. Energy weak today. Consumer discretionary, another area of market weakness this morning. It is off of the lows quite significantly, but it is still down 0.8%. And trying to continue the bounce that it saw starting last week. And then finally, earnings are picking up, and Netflix reported yesterday. The numbers, bottom line, looked really good. They actually, I think, came up a little short on the revenues, but their subscribers were way above expectations. And the market rebounded, or Netflix rebounded, I should say, got very close to that October high, couldn't quite get there, and we've seen selling since the open, but still Netflix up $17 today. All right, Erin, it's hump day. Lots of stuff going on in the market. We got ups, we got downs, we got earnings, we got interest rates in the news. We got a smorgasbord.
Oh, absolutely. I did have to, we did talk about it earlier on the show, but I just remember yesterday, for anybody who actually watches the Talking Heads, I was just so shocked at how bullish they were. I mean, they were like, they couldn't contain themselves to tell us how the correction was completely over, except for the technicians that came on. The technicians were all cautious, like we are.
Speaking of technicians, we've got one of my idols here today, Martin Pring. How are you doing today?
I'm doing fine, thanks, Tom.
Always great. Always great to have you on the show. I'm so excited. We don't get you on here often enough, unfortunately, but I tell you, our viewers are in for a treat today. See what you're thinking about the market, but welcome to the show.
Thank you very much.
And we were just talking right before the show. I know you live down in Florida, but you were able to miss that hurricane that swept just to the west of you, right?
Yes, indeed. We were very, very lucky there.
Yeah, I know that area, that part of Florida, I guess is down around Panama City Beach in that area. I think they're going to be recovering for some time, but I'm glad it missed you. And, of course, our thoughts and prayers out to all those in that area that are still going to be rebuilding for quite some time. But if you can stick around with us for a little bit, Martin, we're going to bring you back. I know everybody would like to hear your thoughts of this crazy volatile market we've seen of late, and maybe what you're thinking longer term. So stick around.
Okay. Sounds good.
All right. And Erin, why don't you take it away?
Yeah, absolutely. So our upcoming schedule tomorrow, we do have Julius de Kempenaar, Mr. RRG. He'll be in here. Mary Ellen will join us again on Friday for what's hot and what's not. And then we have everything stock charts coming up on Tuesday. Rumor has it that Chip might be with us. And then we have Roman Bogomazov, I think I pronounced that right, coming in on Wednesday. So it should be a great rest of the week and a great week to start next week. Today, we do have Martin starting off the program after our technical news. The 10 and 10. The very first symbol is going to be Noodles and Company, NDLS. And then we will finish off the program with Anatomy of a Trade. You can see a few that have gone right, wrong. I don't know, Tom. We'll we'll be sharing some interesting ones, I'm sure. But let's go ahead and get started with some economic reports and headlines news.
Yeah, I think that last segment will be more like anatomy of a stop out.
Right.
For me, because that's about all my trades have been doing of late, but we'll talk about that later. As far as economic reports out today, we saw September housing starts come out, 1,201,000 units, market expecting 1,216,000 units, so a little bit of a miss there. September building permits also a little short, 1,241,000 units versus 1,272,000 units. And also want to mention that later today at 2 o'clock Eastern, we will have the FOMC minutes released. So if you want to know what the FOMC discussed and what they were thinking at their last meeting, you'll want to check those out when they are released at 2 p.m. All right, let's take a look at the Treasury market and take a look at some of these yields and what's going on. Here is a one-year chart of the 10-year Treasury yield. And you can see after a steady move up back to begin 2018, we went sideways for several months and just recently broke out. And of course, this is one of the things that the market is very fearful of. We're breaking out above this prior top around 3.11%. We've been holding that level. You can see that the rising 20-day moving average continues to prop it up and hold as support to the downside. So there's certainly a group of folks watching the market who believe that this rise in Treasury rates is going to be a problem for the U.S. stock market. I'm not among those. And I know we don't have a lot of precedents out there for when the 10-year Treasury yield goes down to 1 or 2% and then starts rising. But I do want to mention the chart here from the 1960s. This is probably the most recent data that we have that's comparable to what we're going through today. But you can see back in the early 60s, we had a pretty low 10-year Treasury yield. And as the Treasury yield was rising, so did the S&P 500. The S&P 500 is here on the bottom. So there's always been a fairly tight correlation between the two because, again, I mention this a lot, but if money is rotating away from treasuries, and that's what sends treasury yields higher when treasury prices are dropping, if that money's coming out of the bond market, usually it's coming out of the bond market because of strengthening economic conditions. And if that's the case, we should expect corporate America to be increasing their bottom line. And as a result, the S&P should go higher. So I typically look for the S&P to kind of follow the 10-year Treasury yield unless the yield is going up for the wrong reasons, which could be inflation or other things that we need to keep an eye on. But I do think there's a level where we get to on the 10-year Treasury yield where it is too much for the economy and will begin to kind of squeeze those earnings and future earnings. And I think in the 60s, you could kind of see we did have about a 9-month, this is like a little mini bear market. Back in 1966, we went down about 20% on the S&P 500. And that was a pretty steep, sudden rise. And that probably sent some shocks into the market. But after we pulled back and then started rising again, you can see the S&P went with it. I believe, and I just throw this number out here, but I believe the 5.5%, 6% level, that's what happened back in late 1960s. We got up to about that level. And that's when the S&P 500 really started struggling as the yields continued moving higher. So I don't know if that's going to be the number or not, but I don't believe that 3.15% is the number where all of a sudden we are not capable of growing our economy any further. So I am not in the camp that believes higher interest rates is going to slow down the stock market, at least not yet. But I don't know, maybe I'm in the minority. We'll see. Okay, let's take a look at some of the earnings reports out last night and today. Last night, Netflix, a big one came out. Check out their beat right here, 89 cents versus 68 cents. That is what you call a major blowout in terms of earnings. And top line did, actually, I think I mentioned they came up a little short. I think because they barely beat. To me, that's coming up short on Netflix. But they came in at $4 billion, and the market was expecting $3.99 billion. But still, that bottom line, 89.68, very strong. And you can see the other major companies that came out with earnings, all of them pretty strong. United, which was the only one here on this list, which came up a little bit short, actually raised their guidance for the third time in 2018. So even that miss wasn't bad because the market likes to look forward. So with United raising their forecast again, they were having a pretty nice day, especially at the open earlier. But let's take a look at some of these charts here. And I'm going to start with Netflix. And let's see what we've got. We've got Netflix. Here's the gap up. This is just a 6-month chart. You can see clearly the gap up, but we've been selling off since the open. The stock is now down almost $20 from the open. It had opened at 378, and that was up about $31 or $32 from yesterday's close. But we have given back more than half of it already. We'll see how we finish today. Volume strong, as you might expect. I think the key for Netflix is trying to get back through that reaction high to open October, because we had the huge gap down back in July with Netflix prior earnings report. We moved higher, and since then, this 380 to 385 area has been very tough, and today's earlier high was 380. So I'm not surprised that the sellers have come in there. I think Netflix goes higher in time. I think it's a great company, but I don't believe it's ready just yet. A couple other reports I wanted to go over. IBM, believe it or not, missed their revenue guidance. I'm saying that with a little, with tongue-in-cheek, little sarcasm, because IBM for a long period could never beat their revenue estimate. And then I think the last quarter, maybe the last couple, they finally ended their streak. Well, they came up short again today. Good news is maybe we're putting in a long tail below that prior support level. So we'll have to see how IBM closes, but a close back down anywhere near the earlier low, and I think we have a breakdown here with IBM. CSX, part of the railroads that were so strong throughout most of 2018. We did see temporarily a breakdown in CSX actually about a week ago. Came back up to the 20-day. They reported their results. They beat top line. They beat bottom line. Got a gap up, but it's not holding, and we're trading back below that 20-day. So I'm not really liking that so far. UAL did beat top line. I mentioned they came up a penny short on their earnings, but they raised their fiscal year 18 earnings guidance for the third time in 2018. Market liking it, although I do see a little bit of overhead resistance just above the 90 level. And then the other one I wanted to show, this was an interesting one, not one that I featured at the beginning of the show, but Cree, which is in the semiconductor space. Stock had been torched from 51 down to 34. It lost a third of its market cap, a third of the value of the company in about 2 months. And they came out, and I was a little surprised. They beat top line. They beat bottom line. They raised their second quarter guidance for earnings, but they lowered their second quarter revenue guidance. But I'd have to say that report really surprised me after seeing what the stock had been doing and what semiconductors in general had been doing. I was looking maybe for Cree to miss on top and bottom line, and yet they came out with numbers that were well in excess of their estimates, especially bottom line. So anyhow, but one of the problems that we have in the market, my last comment here, is on the volatility index. This is where we have seen this huge spike up to 29. I don't like to trade when the volatility index is much above about 15 or 16, because I just don't think you can see what's coming next. We saw the huge rally yesterday. I don't think too many folks were expecting that kind of a rally off the selling that we had. And then earlier today, it looked like we were going to give it all back, and then quickly we're right back up again. And unfortunately, that is kind of the character of the market when you have a volatility index that is above that 15, 16 area. So I think we still need to be very cautious in the near term. Like I said, I'll be interested to hear what Martin has to say here in a few minutes. But first, let's get some upgrades and downgrades from Erin.
All right, let's go check it out. Lots of them today. I thought very interesting. So let's go ahead and take a peek. All right, let's get started first with the upgrades. Arista Networks was upgraded today by BMO Capital from a market perform to an outperform. A nice breakout on this upgrade. You can see even the PMO starting to turn back up, and actually had been even before today. So I like the look of that. I don't like the look of the volume declining on this rally. Of course, that's been a problem, I think, for the markets in general. But a nice breakout. I think you could look for overhead resistance, up here at this top we had back in September around 280.
Hey, Erin.
Yes.
Not sure, but I think you've got a different screen up. I think it's like
Oh, you're looking. Yes. Oh, shoot. Okay. Thank you. How did that happen? Thank you. Sorry. There we go. That's better, I think. Wow, that looks really weird. I gotta move over somewhere here. Let me get... Sometimes. Okay, we'll try it this way. gosh, tell me when you see it, okay?
I'm seeing ANET or Ariston.
Okay. Yeah, it's really weird. It's falling lower on my screen, so I can't see everything, but that's okay. All right, as long as you can see the whole chart, that's what's important. Okay, so we do have that breakout. I'm looking at 280 as a possible high there. So let's go look at the next one, Delta Airlines. And Delta Airlines was upgraded today by Deutsche Bank from a hold to a buy. Again, nice breakout we're going to see on all of these upgrades and downgrades. PMO is starting to curl upward, which I always like to see. But again, volume trends not looking that great, although we'll have to see what happens by the end of today. If on this breakout we get some good volume. Right now, heading up toward overhead resistance right around 56. All right. Pure Storage also upgraded today by Goldman from a sell to a neutral. And you can see as far as this chart is concerned, also doing well today on that upgrade. I note that we have a gap here that's in the process of being filled. The PMO is flat on this rally, so I don't particularly care for that at this point, but I would look for that gap to be covered up. I don't know if we're going to get that much action past that. I'll want to watch that PMO. If we get a nice move to the upside on the PMO and it's not so flat, I think that could be a possibility. Workday Incorporated. All right. Workday was upgraded by Bernstein from market perform to outperform, and a nice curl on that PMO. Very similar charts here, I would have to say. You can see at this point it's hitting that overhead resistance at those tops we had back in March and May, and it does appear we're going to get the breakout. If we can get that breakout, I'd be looking for a move to test those highs we saw back here in August, September timeframe. I think this chart looks pretty good. All right, downgrades. Before I show you, well, before I talk about this one, I did want to let you know there were some other big name upgrades that I just didn't look at the charts on. Delta Airlines had its upgrade, but so did American Airlines and United Airlines were also upgraded today. Domino's Pizza was upgraded, Tapestry, and Rig was upgraded today. From that one I was more interested in because, of course, I'm holding that one still. All right, downgrades. Here we go. Home Depot is the first one, and notice the drop on that downgrade, pretty ugly. Drop below that support, short-term support from August. I'm looking at the 170 area as a possible stopping point for support. The PMO is pretty oversold as far as near term is concerned. So I think that could be a positive, but there's room for it to move lower. You can see that typically it gets up to around that 3 or 4 area, which means we could see it go all the way down to -3 and -4. So looking for that one to fall. KB Home was also downgraded today from a neutral to an underperform. It's been in a declining trend channel for quite some time, and now it's even breaking down from it. I think the only good news is, we could be finding some support here, when you look in the thumbnail, but this looks very similar to what we had here earlier in October. PMO was decelerating and is decelerating, I should say, on that consolidation, but still headed lower. Silica Holdings was downgraded today by Jefferies from a buy to a hold. In this case, I noted a falling wedge. And, that's a bullish pattern. You should start looking for breakouts from that. However, bear market rules on this particular chart. Look at how far the 50 is below the 200-day EMA. Don't expect bullish patterns to necessarily execute when a stock is in such a decline and in a bear market configuration. And then add to that today is that PMO sell signal that's on tap. A couple other big name downgrades that I didn't go over: Diamond Offshore, DO, Lennar Homes, LEN, Lowe's, and Netflix, as well as Martin Marietta. I found the downgrade on Netflix rather interesting. I don't know. I'm thinking that one looks pretty good. And after the hullabaloo about it yesterday and how great it is. I'm surprised to see that downgrade, but that's all I have. So let's go ahead and bring in Martin. All right, Martin, are you still there?
Yeah, I'm trying to share my screen.
Yeah, no problem. Welcome to the show again. And I know you've got some really interesting information to share with us on your current market outlook. Also, Martin has a survey going on in the polls area. So go ahead and take that question poll.
Hey, Martin, I got a question before you get started.
Okay, Tom.
When you see these really volatile periods like we had back in January, late January, early February, and of course what we saw last week, does that change any of your, are you longer term? Does that not really bother you? Or how does that impact what you do with market?
Well, when you say, does it bother me, do you mean, does it make me more bearish or?
Does it affect any of your holdings or how you view the market and your positions, or do you kind of weather those storms and look elsewhere for your topping signals and those types of things?
Generally speaking, I'm looking at the longer term indicators and inter-asset relationships. That's what causes me to go bullish or bearish on a specific market.
Okay, so sentiment and the panic, short-term panic that's in the market really doesn't have that big of impact.
It has a big impact over the short term, but I don't think sentiment has a big impact over the long term, unless you're kind of at the top of a bubble, kind of like we were in the year 2000. That was obviously the top when you had huge amount of bullish consensus at the time, and technology stocks were all over the covers of Time magazine and Newsweek when they mattered, and so on and so forth. So there's different kinds of sentiment peaks and troughs. We tend to look at the shorter term stuff, but sometimes at a very long term turning point, you see different, more intense and more widespread sentiment.
Okay, well, normally I wait and hold my questions until after your presentation, but I thought with the timing, with you being on the show and the volatility just kind of screaming higher last week, I thought I'd ask before you got going, but take it away. I know you got a great presentation lined up for everyone.
Okay, so feel free to ask any questions anytime. And number one. Number two, could you give me a 5-minute warning when I'm close to getting to the end?
Okay, sure.
Please, thank you. So obviously we had a pretty nasty drop last week, and it's put a lot of shorter term indicators in a bullish mode, indicating that either we're going to get a sideways movement or we're likely to get some kind of a retracement rally. That's the good news. The bad news is, unfortunately, the collapse that we saw last week has done some severe technical damage to some of the averages, especially some of the overseas averages. So let's just take a look at the short term right now to kind of justify what's going on in terms of the bounce we've seen since Friday. This is a price volume oscillator, and the green arrows flag selling climaxes, and the blue arrows flag buying climaxes when the PBO has reached a high level and starts to reverse. So you can see last week we saw a buying climax. The question then becomes, what's the most likely outlook from a buying climax? Are we getting a quick reversal like we did in 2016 here, and again in 2014? Or more likely, are we going to get a bounce, which we're seeing right now, and then a test of the low, and then a move to new highs? And that's, of course, the $64,000 question. And the answer is that most of the time, you can see in this case, there's 4 instances of a consolidation before it rises, and 2 indications of a quick reversal. So based on this quick survey of the last 4 years or so, it would suggest that we're going to see a bounce now and then a test of the lows later. That's also indicated by the next chart. If I get into my chart package here, there we go. This time we're looking at S&P versus the percentage of S&P stocks that are above their 50-day moving average. And the red line indicates when you get into oversold condition. And you can see what happens with the green vertical lines that I've got flagging those periods when we're oversold. Once again, this chart goes back to 2006. and it encompasses the 2007-2008 bear market. And you can see when we get an oversold condition in the bear market, we don't get much response on the upside. Sometimes we get a sideways movement. Sometimes it ignores it altogether, as it did over here and as it did over here. So in a bear market, when you get an oversold condition, it doesn't necessarily mean you're going to get much of a rally. Probably what you're going to get is some kind of a consolidation. Whereas in a bull market, which we're seeing over here, you're seeing much stronger recoveries from these oversold conditions. Which brings us to the current situation where, once again, we've got an oversold condition. I'll just go into the last year and a half or so. The same chart, same indications, but this time we're looking at the period since 2015, and you can see that when we get a reversal from the oversold condition, you get a rally, and then you tend to get a reaction, and this happened in the last 3 occasions. So once again, it would suggest to me that we've had a bit of a rally already. So the question is, the outlook, I think, is that we're going to see a test of the lows before long. Now, the problem with all this is that we've done some serious damage. Here's the S&P back to 2016, and you can see it's broken this very thick line. And I made it a thick line deliberately because I want to emphasize the fact that it's a the extended line is a very, very important resistance area. So when we're above the line, it represented support, and from where we could expect to see a bounce, either actually touching the line or approaching the line, and consistently it did so. Now that role of support reverses itself to one of resistance. So I've emphasized that resistance by that very thick line. So it seems to me that the thing we need to worry about is the fact that we're probably going to get a test of this low, as indicated by these other oversold conditions and the selling climaxes in the previous charts. And that means that this line, this thick red line, of course, is going to continue to advance. So it's going to be very difficult for the market to get back above that trend line again. Also, we're looking at the other indicators which aren't so oversold. This is my Dow diffusion indicator. This is where we take a basket of Dow stocks and figure out which ones are in positive trends. And when they're all in a positive trend, we get a high reading, and when they're very few in a positive trend reading, you get a low reading, and that tends to be an oversold reading, and that tends to generate a rally. Well, one of the problems is that we broke this uptrend line back in mid-September in a similar way we did in January. And that didn't signal the end of the world, of course, but it did signal that we're going to probably see an extended trading range period, which is what we did see for a while until the Dow actually went up and played catch up at the time and made a new high. So this indicator right now is not even in an oversold region. It's just a little bit above. This is yesterday's close, just a little bit above the zero level, above the balance line. So it's not yet oversold. So there again is another reason for suspecting that we very well could see a test of the low. And that would also, in the case of the Dow, mean a test of this red line here, which is, of course, the 200-day moving average at 24,900. So when I talk about damage, I can point out to even greater damage being done around the world. This is the MSCI World Stock ETF. And you can see that initially, when I say initially, I guess the middle of this year, it started edging through this uptrend line here, going all the way back to 2016. And then the market crash last week, or we won't call it a crash, call it a sharp sell-off, I guess, caused the price to drop below this trend line here, which is sort of marking the top of a sort of a head and shoulders, a little bit of a shoulder here, big head and lots of right-hand shoulders here. Doesn't really matter what you call it. The fact is there's obviously a battle between buyers and sellers between these two trend lines, the green line and the red line. And the battle was won by the sellers because it broke down, and now we're seeing basically what we should normally regard as a retracement move back towards the extended trend line again. And it's also below its well below its 200-day moving average. So the world is not doing as well as the US. Now underneath we got my special K indicator. For those that are not familiar with it, there's a write-up on the in the chart school, but basically what it does, it's a long-term indicator with short-term implications. What I mean by that is that we construct the indicator by adding long-term momentum to intermediate-term momentum to short-term momentum, and we get one big curve. And most times, I estimate about 70% of the time, this indicator will bottom along with the market. So here we see a bottom with a green arrow, and up here it's peaking with the market so far in January. This is the World Stock Index, of course. And so if it does that about 70% of the time, it's very easy when you've got, looking at the hindsight, to go back and look and see where the peaks and the troughs were. The point is, how do we know that in real time? And the answer is we look for trend line violations, and we look for a crossover of the signal line here. And because it's a fairly jagged indicator, because it's got the short-term momentum stuff in there, we can actually sometimes draw price patterns. Well, at this point here, obviously, it looks like both of these series, certainly so far, peaked in January on track. But there was no trend violation in the special K, which we've now seen with this trend line break and the fact that it's moved below its signal line. So as long as it stays below this green resistance trend line, I'm marking this indicator as in the bearish camp. And you also notice that it made a new post late 2017 low, whereas as the index itself did, as the price itself did, which sort of indicates the two are kind of in gear on the downside. Further moving on to the global scene here, we see this is the Dow Jones World Index, which is a similar indicator to the ACWI. One of the reasons I like this one better on a stock charts platform is we can go back with a much longer history. You can go back to the 1990s. But you can see the trajectory is very similar, whereby we reached a high in January. We saw a trading range break down from the trading range below the moving average, and now we're tracing back to the trading range. So it's very similar to what's going on with the ACWI. You also notice that we have the global AD line, which is constructed from daily plurality of a basket of individual country ETFs, rising or falling, same way we would do with the vast decline line on the NYSE or the NASDAQ or in these other indicators. And in this case here, it's broken below this uptrend line going back to 2016. So the advanced decline line has broken as well. It's just around its 200-day moving average. It was a little bit above it yesterday. But the big thing is it's a decisive break below this trend line here. So that all suggests to me that we're having some problems in the global market here. We're also having some problems in the US market, because here we're seeing the NYA, which I think is a better measure of the market than the S&P, because it includes all the stocks listed on the NYSE. And I've drawn another thick trend line here. It's a difficult trend line to draw, because when you're drawing a trend line, you want to draw a line which sort of basically reflects the underlying trend as best you can do it. And in this case here, it was breached a couple of times, which I don't mind seeing it breached once. I don't like seeing it breached twice, but it seemed to me this is the best way of drawing a trend line, where it intersects with as many different points as possible. And you can see that each time it comes down to the trend line. You couldn't even hold below this trend line for very long. So the trend line represents support, so it couldn't hold below the support, which really emphasized the importance of the support. So anyway, here's the trend line, and once again, you can see that we're seeing a tracement move back towards the trend line, the extended line. But it has obviously got some way to go before it gets through the trend line, and created some pretty important damage, technical damage, by crashing through the line. So even though we got a short-term oversold condition, we'd like to get a rally. We already seen a bit of a rally take place, but probably able to hold below these lows for a while. We've still got a problem of getting above this extended trend line. And there's also a possibility it could be forming a head and shoulders top, because this red line here would represent the neckline. Here's the shoulders. there's the head, and this current rally would represent a possible shoulder if this red line, dash line, was broken on the downside, which is what, about 12,350, somewhere around there.
Hey, Martin.
Yes.
On that chart, I mean, how much consideration do you give? I mean, when you look at the beginning of 2016 through the beginning of 2018, the move from the bottom all the way to the top, that was a 50% move in 2 years. Now, I mean, I understand, with a trend line.
From here to here.
Yes.
Yeah.
So you've got, I mean, it's up, 4,500 points, and it started from 9,100. So that's roughly 50% in 2 years, which is a lot to expect from a huge index of companies. I mean, it's one thing for a company here or there to go up 50% in 2 years, but for an entire index, I mean, should we be giving the market the benefit of the doubt to consolidate a bit more? That would be question number one. And then the other question I would have for you is, when you looked and I think it was the ACWI, which was that MSCI global market ETF. I just had a question on that as to how much weight you would give the February low, because even though we did break that trend line, we've been holding on to the February low that was established with a lot of selling. So
you're talking about this one here.
I'm sorry, what?
You're talking about this one here?
Yes. So that slight uptrend. Yeah, that slight uptrend broke. But if you look back to the low back in January or early February, we actually went right down and tested that price support off that initial selling and then started to bounce. I was just wondering how much, I mean, do the trend lines mean more to you than those initial pullbacks and price support? How do you view that?
Well, it depends on the nature of the trend line. I mean, to me, a trend line gets its significance from its length, the number of times it's been touched, and the angle of ascent or descent. If it's only been touched twice and it's a steep line and it hasn't lasted very long, I wouldn't give much credence to it. Mm-hmm. Same thing with a support level. If you come down and bounced on that support level a number of times, I give that much greater credence than I would a trend line. Also, if the violation of that support means you've now set up a series of declining peaks and troughs, that's another thing you'd be looking at. So it depends on the situation, really. In this case here, if this low here had been broken, you then have set up a series of declining peaks and troughs. So it was vital that the price hold below that support there. Now it's broken that support, and that really gets me quite concerned.
Okay. Perfect.
You asked me another question, and I forgot what that was now. It was on this chart here, I think.
Yeah, it was on the dollar NYA. Yes, that one. I was just curious because we had risen so much in 2 years. You were just talking about the ascent, the steepness of a rise. And over 2 years, basically the New York Stock Exchange rose 50%, which is, pretty high for the New York Stock Exchange to rise that much in a short period of time. So my question was, would you expect maybe that the NYSE might take more time over a longer period of time to consolidate? And I mean, just my feeling is that those lows that we saw earlier in the year back in February and March are very important support lows, because that came with a lot of short-term panic in the market, and that's where the buyers stepped back up to begin buying. So I would be looking more like down around that 12,200 area as what I would consider more major support to allow the NYSE to kind of consolidate after these massive 2-year gains. So my question was whether or not you give that any consideration, the fact that we did go up 50% in 2 years, and maybe we just need to consolidate a little bit longer.
Yeah, there's very few examples of markets going straight up and straight down. 1929 is one. But generally speaking, after a big rise, you would expect to see some distribution going on, a battle between buyers and sellers that takes place. And the bigger the rise, usually what you would expect to see is a bigger battle between suppliers, between buyers and sellers. I wouldn't say that I would be waiting specifically for that to happen. If we now saw a quick break below this red dash line here, that would really get my attention, because it would mean it would have done a lot of it technical damage elsewhere with 12-month moving averages and so on and so forth. So it depends on the situation, Tom, in my view.
Okay, fair enough.
So one of the things which we've experienced in the last, 12 months, I guess 10 months, is the fact that the US stock market has outperformed the world. In this case here, we're looking at the SPX against the Dow Jones World Index, and this is a monthly chart. So this is pretty well for most of 2018. We've seen the US market outperform the rest of the world. And clearly there's no sign of that abatement because the 12-month moving average is still intact. This trend line is obviously still intact. And our long-term KST, which monitors moves around 9 months to 2 years, is in the early stages of a rise. Doesn't mean to say it's going to go up to 150 or 100. It could turn at any time, but right now, it's certainly not up here where it's overextended. And one of the reasons, it seems to me, for the superior performance of the S&P has been technology stocks, and specifically the internet commerce stocks, which, according to Dow Jones, have gone up by a factor of about 40 since 2002. That's a pretty huge, and since 2009, it's about a factor of 20. That's a pretty huge move and sort of indicates a bit of a bubble to me. And so what I'm looking for are possible triggering point. If we buy the argument about the world market having peaked out, the NYSE having broken its trend line and looking vulnerable, if it's going to come down and we're going to see a bear market, what are the triggering points that we would expect to see, or the triggering areas that we should be monitoring that might be a bellwether for a bear market? And one of these, I think, would be the Internet Commerce Index, because it's come up so much. So one of the unfortunate things about this chart is I've drawn a trend line which actually isn't a trend line. And I've tried to save it several times this morning, and for some reason this particular chart is corrupted. But I just bring it out to point out that this is not really a trend line. I've drawn it as a trend line, but the program won't save it this morning where it touches at least 2 points. So it doesn't matter, because in the next chart, I've got the weekly data for the same index, the Dow Jones e-commerce index. And you can see from 2009 that the e-commerce index is right at the moving average, which is a 65-week exponential. And it's also at this trend line here. And this is the relative strength of the commerce index, or the e-commerce index, against the S&P. It too is down at support. So this is what I'm watching very, very carefully indeed, because if this strong area of the market, one of the areas that's gone up nearly 40 times in the last 15 years or so, suddenly starts to crack, to me that's going to ring a bit of a bell that maybe the rest of the market is likely to follow suit. And so we can take a closer look at this index, I think. Yes, we can. So now we're looking at a period since 2016, and you can see it has broken this trend line. And based on what I was telling you about trend lines before, fairly long trend line, it's been touched or approached on numerous occasions. I don't know, countless occasions on the way up. And now it's below that trend line, and it's below its 50-day moving average and its 200-day moving average. A little bit oversold right now. So that's done some serious technical damage on the shorter term chart. Because you remember the longer term chart, we had a longer term trend line, which you're right at. So if we see maybe a bit of a bounce and a retracement here and then a move down below the previous lows, that would be quite a serious thing, because it would also break down on the previous chart. But right now it looks a little bit oversold. Here's the relative strength of the e-commerce index to the S&P. It's obviously formed a head and shoulders top. There's the shoulder, there's the head, that's the shoulder. There's the neckline. It's broken below that. It's broken below this uptrend line going back to 2017. So the relative action has done some serious damage. I think it's likely to consolidate a bit in the next couple of weeks, because the short-term KST for relative action has just started to turn up again. Shall we just take one more chart of this index, and here we're looking at this top, which has been completed back here in beginning of the month. Now we're seeing a bit of a retracement move towards the breakdown area. There's the 200-day moving average, which it's well below. The RSI is interesting, because during the bull market, you don't expect the RSI to get into oversold territory for very long. sorry, you do expect it to get overbought for a long period of time. It's oversold, you don't expect it to get to, and if it does, it tends to bounce significantly quickly from the oversold condition. In this case here, it doesn't show any oversold readings except here, which suggests that we may be in a bear market, because here's the peak of the bull market perhaps, and the secondary peak was unable to get to an overbought reading. We've been unable to get to an overbought reading during this whole summer, early fall period, but we have achieved an oversold reading. So that is a little bit of a hint that the character of the RSI may be hinting a bit at a bear market. So anyway, what we're seeing right now is that bounce that we were looking at in the previous chart, because the oversold condition in the KST and the oversold condition in the RSI. And also that may be the right shoulder of the Head and Shoulders top. There would be the left shoulder, there will be the head, and this would be the right shoulder. So I'm not forecasting that's going to happen. I'm just saying that's a possibility. And if it does break significantly through that trend line at 1060, we'll say down to 1055 or something like that, that would then complete this Head and Shoulders top. So one of the areas to look for triggering possibility is the tech area, specifically e-commerce. Another one I think that has traditionally, or actually in the last bear market, signaled a problem was in the junk bond area. So this is the HYG, which is the iBox High Yield Index, High Yield and ETF. And it looks to me like it may be forming a Head and Shoulders top. It's gone through here a couple of times, or it went through here once, has started to bounce again. So we're going to have to wait and see, because that was one of the causes of problems in the previous bear market. And so the thing I would be looking for, less so on the price of the HYG, but more of its relationship towards government bond prices. So here is the S&P just here, and underneath is the ratio of the HYG high yield bonds against the 7 to 10 year Barclays ETF. So this is junk bonds against government bonds. And the idea is that when the indicator is coming down, it indicates people are rushing towards safety because they're losing confidence. And when it's rising, they're moving more into the high yielding HYG and less into the governments. And that means their confidence is rising. So what we're seeing here is these red lines here, or red arrows, which represent a subtle decline in the ratio as the S&P is moving sideways. And each of these bear markets or mini bear markets was preceded by some kind of a divergence in this relationship. Well, fast forward to the present time, and you see there is no divergence between the two. So this potential triggering point doesn't appear to be likely to be one of any cause of any bear market that we might see going forward, which it was in 2000, it was in 2007.
Hey, Martin.
Yeah.
Actually, if we can go back, to that chart right there. First of all, we got a couple more minutes here, but I wanted to take a look at this and just kind of maybe explain the theory of this chart. I mean, is it that when you take the high yields and divide it by, say, government bonds, it's kind of a risk-on kind of an assessment? And
Correct.
So when you start to see this roll over, it means that traders are not nearly as aggressive and therefore could be pointing to future weakness in the market. Is that kind of how you interpret this?
Well, I would go further and say pointing to potential economic weakness, because you've got a high yield bond, it's not very good credit. And if you're going to get some trouble in the economy, credit defaults are going to increase. So that's really what it's all about. Players in the bond market expecting better economic conditions or weaker economic conditions, which would tend to trigger more defaults.
Okay. Sounds good. All right. We probably have another minute or so if you have a couple other charts you'd like to share with everyone.
Yeah, I've got quite a few.
That just means we're going to bring you back again.
Okay, so the third thing I want to cover, I guess I want to cover a lot more, but the third thing I'm going to cover is the other possibility of a triggering point, which would be higher yields. Because traditionally, when yields reach a certain point, that triggers a weakness in the economy, which then triggers a recession down the road. stocks start to smell that out when the rates get to the cringe point, so to speak. And so rising yields at some point causes problems in the stock market. Well, here is the TYX 30-year yield, and you can see it's broken out of this lovely base here. And here are the short-term KST, the intermediate and the long-term. They have one thing in common. They are all rising. And that should spell trouble. But at some point down the road, that could spell trouble for stocks. I'd be a bit careful about forecasting higher yields but sentiment right now is from a country point of view, is completely in the wrong direction from where you want to be if you're going to have higher yields. Everybody's bearish on bond prices, everybody's bullish on bond yields, and the commitment of traders suggests that the people who know about these things, the hedgers, are actually close to a record net long position. So I'd be a bit careful about forecasting higher yields, but it doesn't matter. The triggering point to me is not the level of the yield, but how they interact with the stock market. And the way we look at that is with the stock bond ratio. When the stock bond ratio is rising, it means stocks are outperforming bonds. And when it's falling, it means that bonds are outperforming stocks. So this is the SPY against the TLT, which is the Barclays 20-year trust. And you can see that this ratio has just bounced off this very important trend line going back to 2016. And the special K, which we talked about earlier, is also broken this trend line up here. And so that indicates certainly a loss of upside momentum. And if it now starts, in fact, the next chart, I can show you this area in greater detail here. So you can see it's the uptrend in the special K is still intact because we made a new high here. But it wouldn't take much for it to drop below these two trend lines, the blue line and the red line. And also the KST down here is in I wouldn't say an overbought condition, but it's certainly in a bearish condition. So that's something I'm going to be watching very carefully. This SPY TLT ratio to make sure that it holds above this very important trend line. Because if it breaks below the trend line, then you know that rising rates are adversely affecting stocks. Or alternatively, it could be bond prices are going up because yields are coming down, and that's what's outperforming the stock market. So whatever way it goes, it's very important to watch this line here. So I guess I've used my time up. Is that right, Tom?
Yeah, but that's okay. I mean, first of all, I think that's a good thing, because I think what it does is just demonstrates the fact that so many of us here at Stock Charts like to educate. We like to talk about, a lot of the theory that goes on behind these. I mean, I know you can talk for hours about these charts. Erin and I do the same thing. It's always hard kind of to rein us in because there's so many things that we want to talk about. But there was a question that came up in the room, and I actually have a chart. Can I go ahead and show you the chart and then get your opinion, your thoughts on it?
Just before you do, I just want to show you this one chart here. This is the Shanghai Composite.
Okay.
It goes back to 1995, and you can see that it seriously violated that secular uptrend line. So going back to what I was saying about the number of times it's been touched and the length of the line, that is a mega trend line, and it's decisively broken.
I would agree with you, and that's going to lead to a second question I have for you in just a minute. But the first one I want to show you is this chart. And the question that came in the room, and I think I'm getting the question right, but they were asking about the divergence between the New York Stock Exchange or the NYSE Composite Index and the S&P. And you indicated that the NYSE, in your opinion, is more important because it encompasses the New York Stock Exchange. Here you can see the S&P 500 broke out, but there's a negative divergence in that the NYSE Composite did not.
Right.
And the question was, what do you think of that? Does that have any implications?
Yeah, it's definitely when you're looking at identifying trend reversals, primary trend reversals, you've got to use the weight of the evidence. And this is definitely a piece of negative evidence that goes into that camp, that the NYSE, and it probably also undermines a bit about technology, because I don't know how to make up the S&P. I think it's what, is it 20% or 25% technology?
Arthur Hill would be the best one. I know he follows that really closely. I'm not quite sure.
It's the biggest weighting in the index, and that is why the S&P, one of the reasons that contributes to the S&P rallying to a higher level than the NYSE in October, September. You had another question, I think.
Yeah, and then the other question is, I don't know that we need a chart for this, but you talked earlier about how the U.S. is leading the world markets. And the question that came in is, do we have precedents here? In other words, have we seen periods where the world markets have underperformed like this for a long period of time? And does that eventually drag down the U.S. market? Or would it be the other way? Would the U.S. market kind of lead the world markets back up? What do you think there?
I think you better give me a coin.
Okay, that's a good answer. That's an honest answer.
I think it probably marginally supports the idea the U.S. is going to drag the rest of the world up. But remember, in I think it was 2015, the Chinese, or 2016, the Chinese market came down and there was contagion dragging the U.S. market down with it, albeit in a mini bull, in a mini bear market. But I don't think, from what I've seen and studied, there is a hard and fast rule you can say the U.S. is going to drag the rest of the world up, or the others going to. A lot of it depends on where you are in the cycle. And we're in a cycle that began in 2009. It's now 2018. What's that? 9 years. It's a long time.
Yeah.
And in that period, we've seen two mini bear markets, which have been associated with economic slowdowns. And it seems to me that we're turning over again in a lot of these leading economic indicators in terms of their momentum. What we don't know is whether that will turn into a slowdown in a mini bear market, or whether it's going to be a recession. And we won't even use the word.
Yeah. Well, I know, when you're talking about that breakdown in China, I've looked at using the correlation coefficient at stock charts. You can kind of look to see what is positively and negatively correlated. And to be honest, the Chinese market, the Shanghai with the S&P 500 doesn't have nearly the positive correlation that, say, the European markets do, especially Germany. And so when I see the China market breaking down, while I definitely think it's a negative, I would find it much more negative that Germany, for instance, the DAX just recently took out its earlier price support lows. I think, around 11,800. I'm trying to remember. But anyway, do you have any thoughts on that before we pull up our poll?
Oh, I think the European markets look pretty sick too.
Yeah.
I didn't mean to pick on China. It's just that it just broke in that beautiful secular uptrend, which I wanted to show you. But
yeah, I agree with you. I agree with that.
In this case here, it's going to be very difficult for the U.S. to buck the rest of the world. Really, what we're talking about is technology continuing to go up.
Right.
It seems to me.
Yep, and I think some of what's helping the U.S. obviously is some of that money's rotating away from some of these other markets and moving into the U.S., but that can only last for so long.
Well, it's organic. I think if you're a bounce decliner, it's a narrowing of the bounce, isn't it?
Yep. Okay, so we got our poll up here, and if a bear market's looming, what will trigger it? And higher interest rates is battling a bear market is not looming right now. So, did you have a preference here, Martin? Did you, if we truly are going into a bear market, which of these do you think is the one that might trigger it?
I'm going to wait and see what the evidence tells me.
Okay. I don't believe higher interest rates personally.
If I tell you something, it's only as good as my opinion. But if I show you a break in the charts, then that's what the market's telling us. So yeah. I don't be flippant about this song. But that's what we got to look at, is what the evidence says. And obviously the ones that are closer to breaking down are the ones that are most likely to break down.
Yeah, one thing I would say about this interest rates, and maybe a little side feature here, and maybe this could have been another answer that we could have given to the group, would have been an inverted yield curve, because we are seeing that yield curve coming down quite a bit, and it's not far from the zero line now. Do you have any thoughts on that?
Yeah, I'd be a bit careful about using the yield curve, because everybody else is. I think it's a great indicator. And what I've noticed is that what happens during a recession, or before a recession starts, the yield curve flattens like it's been doing now. And before the recession, it starts to steepen again, indicating a weakening economy. And we don't see that at this point. We're seeing it come down at this point. So I'd be a bit wary about looking at yield curves when everyone else is looking at them. But I still think, taken on a desert island in isolation, a yield curve is a very good indicator. But sometimes when everybody focuses in on an indicator, like they did in the 70s and 80s on M2 every Thursday or whatever it was, that tends to lose its effectiveness.
Got it. Well, I tell you, Martin, it was a pleasure, as always, to have you on the show. Some great insight into the market, and I definitely want to get you back sooner rather than later.
Okay, Tom, thanks.
Yeah, always great information. There he goes. Yeah, he is one of the best. There's no doubt about it. And I tell you, whenever I hear Martin Pring talking or writing an article, or John Murphy, the same thing. I mean, these are two, just titans in technical analysis that you definitely want to keep an eye on, listen to. So really appreciate having Martin on today.
Yes, it was excellent. All right, well, let's catch up here. We've got the 10 and 10. Let's make it the 10 and 5.
Do my best.
All right, so let's just get started. I'm not going to bother to share the RRG, but NDLS, noodles, is the first one.
All right, we're going to try and make this like record territory here on the 10 and 10. Yeah, I mean, in a market that's struggling the way it has, I mean, it's hard to really say anything negative here. You got a bullish PPO crossover. And not only that, but this breakout came on very nice volume yesterday. So I think this move is for real. I would be watching the rising 20-day moving average, because sometimes you get these breakouts, these false breakouts, and then you come back down. But I think this chart looks really good. I see an ascending triangle off an uptrend. I think worst case, it goes back to the 20-day. Otherwise, I see it going higher.
All right. The most popular in the chat room happens to be Boeing, BA.
All right, BA. Yeah, well, it's pulled back recently. I'm going to stretch this chart out just a tad. And yeah, I think you've got a pretty nice trend line here that's still intact, going higher. So let's just kind of draw this trend line. It's not going to be perfect, but it'll be pretty close. Yeah, I mean, I think as long as you hold this recent low in September, probably around 338, 340, I would be okay. I see a continuing uptrend here for the most part. We got the PPO above the center line. So I'm still a fan of Boeing. I would be looking for, if the market continues to bounce and recover, I could see Boeing heading back to that 390 level. But I would treat this as in a range right now between about 340 and 390.
All right. Let's see, the next one I'm going to give to you, WSM, Williams-Sonoma.
All right. This one is on my anatomy of a trade list. So I will explain later how I lost money here. But yeah, I mean, the gap support level is one that I was really watching closely. And that's just the way I like to trade. I like to trade off these gaps, these key support levels. And you can see we went down, kind of tested it. I thought that was going to be a really nice reversal when we had that tail all the way down to about 61 and then came back up and held above that gap support area. But you can see it didn't last, went back down. We've got to get through the 20-day moving average. I think in the short term, so many stocks have lost their 20-day moving averages, and many are coming up and testing it and struggling to get through. So that's going to be the real first test for Williams-Sonoma. And if we can get through and get some volume coming in, I would turn much more bullish. But until then, I think you got to be careful here in the market.
All right. Let's see, for our Canadian friends, Canadian Pacific Railway, which is CP.TO.
Okay, well, a lot of the railroads have been doing very well in 2018, but they did get hit recently. A lot of the transports were down, especially the railroads. This is a pretty good short-term support area that I would watch, though. We got up to about that 265 area in early August, went sideways for a bit, broke out, came back down, tested it, held, and you can see the volume was pretty good in the buying from that 265 level moving up. We came down on heavy volume, but we held at 265 again. Notice the failure at the 20-day moving average as we turn back down. I think we're in a very tight little narrow range here between 265 and about 272. And let's see which way breaks first. If we break down, I'd be careful. That is a little bit of a awkward looking head and shoulder top, though. Left shoulder, neckline, head, neckline, right shoulder at the 20-day. And if we break down, the volume picks up and you go negative on the PPO, personally, I'd have a stop in play.
All right, next one, believe it or not, we haven't looked at it in the last week. Netflix, and like I said, today it was downgraded by KeyBank.
Yeah, it didn't break out on its earnings. And so I always look at that maybe as a little bit of a short-term negative, even though it did gap up and had great subscriber numbers. We've got some key areas to watch here on Netflix. And I think the gap resistance zone from the July earnings, this huge gap down, look at that volume coming in. We have not been able to get through this 383, 400 area. And today we opened at 378, hit a high of exactly 380 before starting to turn back down. I think in the near term, you could use the 20-day moving average, but I really just see sideways consolidation. And when that happens, usually moving averages don't do you a whole lot of good. So I just think probably where we are is sitting between this 380 area of resistance and down, unfortunately, perhaps down as low as 315, 320 area as support. Let's see which way breaks first.
All right. Carlyle Group, Specialty Finance, CG.
All right, CG. Well, it's been beaten down pretty good. It turned before it got down to support. I would say you got a support level there. Here you can see a nice hammer printed, close about 1930. Bunch of moves down here around 1950. We almost got down there and started to pull back up to the upside. We're going to have to try to get through about 2220, which is the next key area of price resistance. And then you've got that 20-day moving average right there, which is going to be difficult. You can see the failure the last time we tested it. So I think we're in a range here between about 19.5 downside and maybe just below 22.5 topside.
Okay, the next one is going to be Renewable Energy Group, and that is REGI.
Well, I mean, the stock has actually been doing very well considering what's been going on. There is maybe a little bit of a broadening top formation. You know, I don't see these as tops very often, but what I am seeing is that the highs keep going up, and if you connect these lows to the downside, it's almost like a horn. And when you get these at the top, you got to be careful, because if we do come back down and take out this bottom level, you want to be careful. I don't really have anything other than that to say negatively about the stock. I like the volume coming in on the recent move to the upside. I just noticed that usually when you have an uptrend, you have higher highs, higher lows. So when you get higher highs along with lower lows, that gives you the potential for a broadening top pattern. So I'd keep an eye on that.
Okay. Another popular one, IBM.
Yeah, IBM reported earnings. So we did touch on that earlier, so I won't spend much time here. But I don't like this breakdown. The gap down below the prior support, and so far holding it. Actually looks like gap down right on support. If we finish down close to the lower end of today's candle with this kind of volume coming in, I think it would signal perhaps another leg lower for IBM, so I'd be careful.
Okay, let's see. Technology Telecom, Intelsat Global, which is just I.
All right, I is breaking out. Nice volume. Now, this one's consolidated for a long time in the PPO and all the way back to the center line, kind of regathered itself. You can see this. We were extremely extended. A PPO rarely reaches 20. That means that you have to have a huge increase. In this case, we went from 2.5 to 13 in 3 months, less than 3 months. That's how you get a PPO reading up at 20. That doesn't happen very often. So we went through several months where we just slowly meandered higher, got the PPO all the way back down to 0, and now it's starting to move again. And you can see the volume. I think the stock looks really good, and I believe on a pullback, right about that 33.5, 34 level, I expect to see buyers again.
All right, and our last one, Hormel Foods, HRL.
All right, HRL, final 10 and 10 stock. Yeah, I'm seeing maybe a cup. I mean, this is more of a defensive play in the foods, but when I'm looking at this, I see a possible cup forming off of that uptrend. But you can kind of see it starting. So I'd be looking maybe for the rest of this cup to complete, get back up to about 42, 42.25, and then we'll see where we go from there. But I love the uptrend, and I'd be looking for some type of sideways, some kind of bullish continuation pattern. And it could be that cup with a handle. The only downside I see is that normally as the right side of the cup starts to form, you begin to see volume pick up, and it actually was picking up on the selling. So maybe a little bit of a crack in the bullish cup foundation there. But otherwise, I think the uptrend followed by this cup doesn't look too bad, and especially given the overall market conditions. I think a lot of folks are looking for safe havens in the consumer staples area, and this is one of those stocks.
All right. And that completes the 10 and 10. Here are those symbols. They will be up in the Market Watchers Live blog area in the chart list. So go ahead and take a look there. I'll have them up, like I said, at the end of the show. All right, let's get into our final market update. Really interesting 10-minute bar charts right now. All right. So as you can see, the markets are making a comeback. You know, we had that decline this morning, but we're seeing the Dow is still down, but only about 21 points. The S&P 500 has now hit positive territory and is up about 5.75 points. NASDAQ also has now hit positive territory. OEX, the S&P 100, is making a move to the upside. And we also can see the S&P 400 and Russell 2000, they're still in negative territory, but like the others, they are trying to make a comeback here and could end up in positive territory before we finish the day. TSX is lower, but also making a bit of a rebound here. We've got the Treasury yields up slightly here, reading 3.169%. UUP gap up and moving higher, currently up 11 cents for UUP. And really, I think good news for gold. GLD is mostly unchanged right now. And, you know, it did make that drop when the dollar started to take off. However, it's still in positive territory. And that tells me that we have buyers in that market, and it's not just a matter of what the dollar's doing. TLT bonds are lower now, reading 114.43, and oil down, gap down, trying to make a comeback here, but still down over almost 2.25% here for USO, reading 14.85. And that's all I have for our final market update. I'm going to pass it back to you, Tom, and let's fly.
All right, we got the S&P 500. This was a chart I had in my blog this morning, so I just wanted to highlight it here. Yeah, I think we've been in a nice channel on the S&P 500 for about the last 6 months, and clearly we broke that. So as we move back higher, the question is, okay, if we are going to go lower, where might we look for reversals? And on a daily chart, I think you have to look at a couple of things. You have to look at that falling 20-day moving average. I think that also would coincide with a back test of this channel breakdown. Which I think 2850 would be a very interesting area for a possible reversal. Look for some type of reversing candle, perhaps, if we get there. The other thing I mentioned in my blog is coming across here, you can see this is where the gap down and the really big volume and the big sell-off took place in early February. And you can also see we just kind of staggered a little bit when we got to this 2815 level back in July, pulled back. And then one of our pullbacks in August came back and hit this 2815 level. So I think at yesterday's close, we were getting very close to this level. And if I click on this and we get a live version, this will show us what's going on so far today. We had pulled back, but now we're in 28 or at 2816. So I think we're getting into this range that I personally would watch very closely for possible reversals. If we get that, I would not be at all surprised to see us make another move back down to test the prior lows. I hope I'm wrong. I'd like, as a bull, to see the market start to strengthen and get through that 20-day. I'm just trying to be realistic here. When you get this kind of selling, it's not unusual to get a bounce and then look for a possible reversal at some point. So, Erin, we got anatomy of a trade. I tell you, it's going to be ugly for me today. But what do you have?
Yeah, I pulled out some old ones, but I do have some two somewhat new ones that I'm following. So let's see. Let's go ahead. I'm going to fix this. You can see the whole chart, right?
Yes.
All right, perfect. Okay, so I'm going to start with Assurant. And I bought Assurant on September 20th at 106.19. So I put that right in here. And when I did it, I went with the Elder system for the stop and used the 1.5 ATR. Stop, and that turned into a 101.16. Now my target is 110.50 plus. I'm expecting it to break out and go even higher. So good news I like to see on my portfolio stocks is a PMO that is now turning back up. So feeling okay about this one. Going to hold on to this a little bit longer. Let's see, the next one I was going to look at P-E-Y. This is a very long-term holding. That's why I've got a weekly chart up here. I bought this one all the way back in June, I think. Yeah, June, end of June 2013. So this is where I got it. This was, I already knew it was going to be a buy and hold. It's a dividend achievers fund ETF. I thought that would be a pretty good one to have in my portfolio. And, granted, we've been through a few difficult points in time here, but we're still on a really nice uptrend. We have broken down below that, but the 50-day EMA is still just holding on here. On the weekly chart, of course, I don't like to see these PMO sell signals and seeing that fall, but my stop I raised up to about 1550. I'm going to take that if we do end up that low. Certainly hope we get the bounce and head back up, but that's one I had to show you. Let's see, another one, Philip Morris. It's another long-term one that I have. And this one I bought back in 2014 as a buy and hold. I just wanted a consumer staple in my portfolio here. Let me get that lower. So I got in here. Unfortunately, my cost basis is now way up in the $80 range. So unfortunately, this drop really hit me hard, but I'm still feeling good about it. Look at that PMO. It is on the rise now on the weekly chart. I see a double bottom here. I'm expecting it to go and at least get up to about 105. I'll reevaluate at that point in time, but I got hit. I got hit when we had that big decline on it back in it looks like the second quarter. But that's I'm an intermediate term trader. I don't have my finger on the pulse every day on these. So, and then the final one I'm going to go through is UNG. And this is a recent pickup. I got this one on September 25th at $25.10. I set my stop down at the 24.25 level. That would be a serious hit. But my target is $40. So I figured that's okay. And here's why. When you look at the weekly chart, I just, UNG is on a tear. The PMO has been rising nicely, even though we had somewhat flat prices. I wrote about UNG. You can see now that positive crossover. I'm pretty excited about having this in my long-term portfolio right now. And that's the ones I have.
All right. Well, I've got a few, and unless we can just stop the show now.
Yeah.
This hasn't been pretty. I don't have a whole lot I don't think I have any gains to show anyone. But that's what the market's been offering up, unfortunately. Not a whole lot to the upside if you're long, especially if you're long and you're thinking that the market is going to favor small caps, which it has done anything but that. So, I'm chuckling about it, but mostly because I did have stops in play, which I guess was a good thing for the most part. I'm going to start off, though, with one where I did not have a stop in play initially, and I'll tell you why. But 5 below, and I'm going to pull this up actually on a relative chart. And so, first of all, this is it's in a nice space. The specialty retailers have been doing very well throughout 2018. If you go down here at the bottom, you can see specialty retailers had really had almost a parabolic relative move versus the S&P back in June. Came back down, settled down, and was starting to build again. I think overall we got a pretty nice relative chart here. 5 has been very strong relative to the S&P, relative to its peers. And on the chart, the absolute chart, I thought absolute price performance has been very strong. So here was the gap up. This was earnings related. And of course, these are the types of stocks I like to buy. And when you come down and you see this stock hitting this, actually the first time I bought it, that's what it was. The first time I bought it, it got down to 120. And when it got down to 120, I got into a half a position. I was going to buy the other half when it got to gap support. If it got to gap support, just kind of build my position on the way down. It didn't get to gap support here initially and went back up, and it got as high as I think around 124. But notice the failure at the 20-day moving average. That probably would have been a clue for me to get out, but I didn't follow that clue. And actually, it would have been right about where I'd gotten in to begin with. But the next day, and this is when a lot of the selling and the high volatility kicked up last week, The stock came all the way down and the volatility was picking up. I actually removed my buy at 115. So I did not buy it at 115. I think I've said on here before, sometimes when the volatility is picking up, what I do is trade fewer shares. So I removed my order to buy it at 115. And I was just going to give it a little room, see what happened. I almost sold it the day it went down to 112, 113, because it did violate gap support. The only reason I stayed in is I only had half the shares. So I thought, okay, let me just give it one more day. Let's see if we bottom. And we did come back up yesterday. The stock closed right at about the 20-day moving average. And if I'd been at my computer, I probably would have sold it yesterday, but I was out. And so this morning, futures were down. This stock opened lower. I was actually able to get at it about 119 and a quarter. I actually feel very fortunate that I lost about $1 on this stock, and it was only on half my position. So believe it or not, this is probably my best trade that I've seen recently, just breaking even. But yeah, FIVE was definitely an issue for me. I was happy to get out and just move more to cash earlier this morning. And I am just about essentially in cash at this point, just kind of watch and see what goes on with the market here so I don't have to deal with stomach issues if the market starts to move up and down. Next stock I had is Williams-Sonoma. Talked about this one just a bit ago. This one also came down to this gap support and actually went a little bit below it. And I just kind of had it on my radar. I thought it was getting oversold. It's part of the specialty retailers as well, which has been very strong. And when you look at the strength, the relative strength that Williams-Sonoma was showing on these prior moves to the upside, I thought it was one of the better stocks. So I was just waiting for a reversal of some sort. Well, we had that little, almost like a hammer. We went down to about 61 or 61 and change, came back up and closed over 62.50 and above this gap support. And I was like, okay, I got it. And went up the next 2 days. I was thinking, nailed it perfectly. And I think I may have had Williams-Sonoma. I think I might have gotten stopped out when I went below the 20-day one other time earlier. But anyway, I tried to get the reversal here. It looked good for 2 days and then right back down. And that closed right there at about 61 and a half, took me out of the position. So I didn't suffer any more to the downside. I also haven't ridden back movement to the upside, but I think this one needs to get through that 20-day moving average before I would be considering it. Next one up is Tilly's. Tilly's I tried to get into at gap support. Actually, I bought it in around 19 and again at 18. It was looking pretty good, came back down and ended up violating that gap support level. And this was a stock that is part of the retail, the apparel retailers, which has been very strong part of the market. And after the earnings, had this huge move to the upside, but then started coming back down. It's now starting to show a little bit of relative strength. But again, look at where it's failing. That 20-day moving average needs to get back through and begin to strengthen. If so, this is one I could revisit, but I ended up taking a loss here. GIII. This was another one that, this was price support move on GIII. After earnings, it nearly broke out, tried to break out above this 50 level, failed. And when it came all the way back down here and tested this price support level, I jumped in and I quickly jumped right back out because it didn't hold on to support. Volume picked up a little bit. It is now beginning to strengthen some, but again, it's got that 20-day it's going to have to try to get through. So another one that I got stopped out. AMD, which was actually my pick for this week in the Monday setups, but I actually tried to trade it on this 20-day test on the pullback at the end of September. Normally, you don't see the PPO here, but the PPO was at its high on this high. So the first 20-day test, I was interested in getting in. I got in. I believe it was right around $30. Nice move the next day. I think I was up 5% and then quickly just washed right back out as the volatility picked up and we saw all that selling in early October. So AMD, I got stopped out. I don't know. I think I lost probably 3% on that one. P-Lab, we're seeing a pattern here. P-Lab, I'm trying to think now. I think it was the gap support along with the 50-day moving average. Actually, I think it was this tail. That's when I got in. I saw the tail go below these prior lows, come back up, and I think when it went back up above the 50-day, which was around 955 or 58, I got in. The next day on the close below 950, I was right back out, or at least below the closes that we had seen previously. So I ended up taking a small loss there. And then the last one I have for today. I could go on and on. But GNRC was one that I had tried to trade, and I'm trying to think when I got into this one. I wish it had been 3 days ago because that's a nice hammer. But it wasn't. I actually think it may have been back when it tested 50. Yeah, it was. When it tested 57 and hit the 20-day moving average is when I had gotten in. Literally the next day it was down, 1.5%, closed down closer to 56, and I just took the loss and moved on. So I think when you get into these higher volatility, we can pull up the summary of the stocks we just talked about. But I think the key, at least for me, because I am a short-term trader, I don't like to be a day trader, but I will be a day trader if my stock goes up and hits my target the same day, or if I lose my stop, because I am trading a lot at support, and therefore at least the support that I'm viewing. And so if the stock continues to move lower, much lower, I'm going to get out pretty quickly. So in a good market that's trending higher, I tend to hold for a few weeks or until I get to my target. But in a bad market like we have had for the past couple of weeks, and on the Russell 2000 really for about the last 6 weeks, I have been getting stopped out routinely. So, but the one good thing is it does help you build cash, and eventually, hopefully things settle down, I'll be able to get back in. But for right now, I'm really cautious, Erin.
Yeah, I have to agree. I mean, I wrote yesterday, I think the strength we're getting right now is an excellent opportunity to move to cash and, just be prepared and have that money on hand when the market does make a good turn where it's not, so iffy. So I know I did get a question in the chat room whether I raise my stops to protect the profits. Yeah, typically I do. I think I even marked it on PEY that I had moved my stop higher just based on what was going on. But typically with my buy and holds, I I watch them, but right now I'm paying attention because I'm worried about the market in general. But typically, if we're in pretty much a bear or bull market, I'm willing to take a little bit of shaving, to the downside, because ultimately I know, well, I believe, of course, that the bull market would continue. So right now, there are some really interesting areas of support that I'm watching.
Yeah, speaking of support, I pulled up the S&P, and this is an hourly chart. And remember, as we were going down, kept talking about how we needed to get back through the 20-hour moving average and above the recent tops. We kept going up around that 2780 level, couldn't get through. Well, we finally did. And the selling that we saw this morning simply went down to that 20-hour EMA. So I actually think the behavior so far in the short term is bullish, but I think the intermediate term on that daily chart is where I'm much more nervous. So if you're watching, I would be real careful if we lose the 20-hour EMA on these pullbacks to the downside, because I think that could then begin the selling on a more intermediate term basis.
Good chart.
Yeah, so let's take a look at what we got coming up for the rest of this week. It was great having Martin on today, by the way.
Absolutely.
Always enjoy having him on. He's got such great knowledge and depth of knowledge. It's not just, this price point, but the way he looks at the market is so unique. But we got some others coming up that are going to be providing different ways to look at the market. Of course, Julius tomorrow with the RRG charts, always fascinating. So look forward to our upcoming guests. All right. I think that is going to be it, Erin. I do want to thank everybody for stopping by. I'm glad you picked today's show because it's always a pleasure to listen to Martin. Please remember to complete the survey as you exit. We do love to get your feedback. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody, and we'll see you back here tomorrow. Happy trading.